Hi friends, I wanted to put this video together to show you what you can do to prepare to buy, whether you're looking right now for the immediate future or in the next 2 years or so down the road. There's a lot of things that you can be doing that will end up saving you money and helping you afford the house that you want, not just a home. Everyone starts somewhere, but it's great to have the best thing that you qualify for. So thanks for watching this summary. What we're going to go over is how to get ready with the three main things that qualify for you for buying: your credit score, your debt to income or DTI ratio, and how to save up what you'll need to be saving up for. Then we'll look at the different types of loans, and you can think about which one you would qualify for or which would be best for you, and then look at what some smart buyers do to get in and save money and then build equity over the time. So credit score. Everyone talks about this and you see commercials about it every day almost, but what credit scores really are from 350 to 850, and anything above 720 is really good. 620 to 720, you'll still qualify for every loan type, and if you have a 580 credit score, you can still qualify for an FHA loan. If you have 579 or below, you need to improve it some probably before you qualify for a loan. Um, but you can look at your score without getting it pulled. Pulling your score does not adversely affect your credit right away. That's a myth that a lot of people will tell you. And what you do need to do to um, improve your credit score or not let it drop is make payments on time. That's the biggest one. If even a good credit score above 700 can drop by 150 points for one missed payment. Now, that's not if you're a day late because you forgot to pay the credit card bill. Um, it is if you're 30 days late. It's not reported to the credit agencies until you're 30 days late. So if you forgot it was supposed to be paid on a Friday and you wake up on Monday, go ahead and pay the bill. 2 days late, 3 days late, it's not going to murder your score. So you'll be all right. It's good to have revolving credit. So some credit cards, and you want to keep those at about 10 to 30% usage, meaning if you have $1,000 limit on your credit card, keep that around $300. Be putting your groceries on that for the month. With inflation, maybe that's not all of your groceries for the month. Get it up to 30% and then pay it off every month. So every time it's reported, it looks like you're only using 30%. It's good to show. Credit agencies like seeing that you are able to use your credit and use it responsibly. That helps boost your credit over time. And don't close accounts. So if you're paying off like loans, car loans, student loans, that's fine. But don't close revolving credit accounts usually, because that looks like you're running from credit. You don't want to be dealing with it anymore, and they'll actually drop your score for that, especially if you're only a few months from buying. If you're a year or two from buying, you might be able to close accounts and it wouldn't be a hindrance. But if you're buying in the near future, leave the credit cards open. You can cut them up if you want to, but um, also don't have too many inquiries for different things. So if you're shopping for a home, then you can't. It's expected that you're going to have your credit pulled possibly a few times within a month. That's another um, stigma or belief that pulling your credit is going to drop your score. That won't happen immediately because the credit agencies aren't even going to know for 30 days that your score is not going to be influenced for 30 days based off of that. But if you have, like, you're applying for a car, applying for a credit card, applying for a mortgage, applying to finance something else like a ring or some furniture, then that will give you a bigger hit on your credit because it looks like you're just trying to finance everything you can, and that's not the consistency that credit reporting agencies will reward. And then, of course, every time you open a new account, whether it be a loan or revolving credit or financing something, your credit will take a little hit. So don't do any of that when you're in the house hunting process. Try and prepare beforehand, and don't be financing rings or furniture or cars or boats while you're in the house hunting process. Now, debt to income. This is another great reason to not be financing things, because debt to income is your consumer debt plus housing debt divided by your gross monthly income. That's before taxes. So the housing portion of that can be around 34% depending on your loan type. And your total debt can be about half of what your income is. So for example, if you're making 40,000, 4,000 a month in income, then and your housing expense is 1,600, that's about 40% DTI. There are loan types that could qualify something that high, but your total debts can only be up to 2,000 if you're making 4,000 a month. The reason for this is we don't want you getting saddled with too much debt that will cause you to have your home foreclosed on, and then you could lose it and lose all that equity and money that you've put into it over time. So making sure that you only buy what you can afford to carry is why there are federal limits on the debt to income ratio, and depending on the loan type, that's anywhere from 50 to 56% usually. That's the absolute most you could borrow compared to your income. Now, what qualifies as income? It needs to be consistent and expected to continue. So part-time, overtime, or bonuses, most of the time they need a 2-year average. So if you've just started a new job, or your part-time hours have changed, or your overtime's inconsistent or going down over the last years, then that doesn't look as good. We want those to be showing consistency over 2 years. If you're on salary, just got out of school, started a job, those are all fine. Those show more consistency and are easier to approve, but we can still approve self-employed borrowers, of course, especially if you've been at the same job or self-employed in the same line of work for 5 years. And so to help out with the DTI, you can look at decreasing your consumer debt. So student loans, car loans, or credit cards, anything else that you have financed, the less percentage of your income that's going towards that every month will give you more room to have a higher housing expense for qualification purposes. So if you only have like 5% of your income going towards your car and no other expenses, then you could get as much on the housing, even more than that 34% usually, as possible, as much on your housing as possible. But if you have like 20% going towards your car, some jewelry you're still paying off, or some furniture you're still paying off, then you're only going to be able to get around 30% on that housing side. What is not included in the debt to income is reoccurring bills like your utilities or subscriptions, because even though you need electricity pretty much for the house and you kind of need the phone plan for this day and age, that could be canceled at any time, so it's not included in your DTI ratio. And now let's talk about saving up. A lot of people will tell you that you need 20% down to buy a house. That's not true. The only thing you're doing there is avoiding mortgage insurance, which could be added on to the loan. But a lot of times that, depending on your situation, that makes sense. It will save you money over time, because even for large loans, it may only be $100 to $300 a month. And if that's the difference between putting down an extra 20, 40, even $80,000 and just getting a lower, putting down a lower down payment and having to pay $300 a month, that's often worth it. So a lot of times you can use 3 to 5% down payment for an FHA loan or a conventional loan. And even if you do have mortgage insurance with a conventional loan, that will go off when you reach 20% equity in the home. So it's going to leave anyway. It won't stay on there for the life of the loan. I think the low down payments is a great option for first-time home buyers or people trying to continue buying without moving a lot of their money around. And you do have to budget for about 3 to 4% that will be needed for closing costs. So that looks like the money that goes for title, the money that goes to originating the loan and the loan company, my company, and also the taxes and fees included, because anytime property is transferred, the government's going to take a little cut as well. And then some prepaids, prepaying your insurance or taxes that you need to when you're getting in there to the house. These can be covered by seller concessions though, especially when we are in a buyer's market like we are now. The sellers are more likely to give you a little bit extra money to help you get in, to get their house off the market faster and get that get to closing. So with a good real estate agent and the seller in the right frame of mind, you can often get help with concessions. In fact, seller concessions can be up to 6% depending on how much money you put down. And then USDA loans, which are only used in rural areas, or the VA loan, which is used by members of our military or their surviving spouse, can be used for 0% down if you qualify, or the house and you qualify for that, which is a great way to get into the market for the first time. Something that can save you money over the life of the loan is paying interest points down at the beginning. So buy down points or discount points is what they're called, and then that's just paying interest up front, and then you'll have a lower interest rate over the entire life of the loan. Usually there's a break-even point of like 2 to 4 years. So if you think you're staying in the house for longer, then it could be a good choice and a possibility to pay down that interest rate so that after month 24 you are saving money going forwards. Another thing that we're seeing a lot of people do right now is use a temporary buy down, like a 2-1 buy down, which gives you a lower interest rate for the first 2 years of the loan, and then you have that normal fixed rate for the next 28 or however long you hold or have the loan term set for. That gives you time to see if rates come a little lower and you have the opportunity to refinance, or just lets you adjust to that mortgage payment over the next 3 years. And every $10,000 that you would change the purchase price of, or the loan amount, because if you wanted to pay $10,000 less dollars down and have a larger loan amount, that changes about $65 to $70 a month of the mortgage, whether you're going up or down. So that's something to keep in mind when you're thinking about your budget and looking at what you can afford. And then if you need or are able to have a gift from family members that can help with closing costs or the down payment, all the loan types allow for you to have a gift, as long as there's a gift letter that says this is not a loan, it does not need paid back. We are giving this to them because you can't, because that would be an additional debt that you would have, and would not help you qualify for it in the same way. And now we can talk about loan types. Conventional loans are the most well known. You don't need 20% down here. You only need 3% for a first-time home buyer, or maybe 5% down, but those need to be your primary residence. If you're going to buy an investment property, it's higher, 15 to 25%, depending on how many units you're purchasing. You can only use all these loans, these two types of loans, for up to 4 units. And if you did use a conventional loan with less than 20% down, you do need mortgage insurance. That's PMI, stands for private mortgage insurance. When it reaches 22%, it would automatically leave, but you could have it requested to be taken off at 20% if you were caught up on your loan. So low down payment is a great option with the conventional loan, and sellers are more likely to accept them because there's a stigma about other loan types sometimes. In reality, with a good lender like myself and a qualified borrower like yourself, then any loan is going to close, but there are slightly easier appraisal requirements for conventional than FHA or one of the other loan types. And for that, you would need a 620 credit score. An FHA loan is not does not stand for First Time Homeowners Association, like some people think it does. It's actually Federal Homeowners Association. So if you've owned a home before or you own right now, you can still get an FHA loan. The only thing is you can only have one per borrower at a time. So if you have an FHA loan right now, then you have to sell the home or pay off the mortgage completely before you could get another one. The least you can do for this loan type is a 3.5% down payment, and you can use it for a multifamily home, which is what I did to begin with to buy my first home and start investing. And the other portion of the house was paying us rent and helping us cover the mortgage. You can use it for 1 to 4 units, but one of them has to be the primary residence of the borrower. So you can't use it for just an investment property. You have to be living in one of those units. With this loan type, PMI does stay on for the life of the loan. It gets increasingly smaller as you go along, but it doesn't drop off at that 20%. You would have to refinance, you would have to refinance because the PMI does not leave an FHA loan if you put 3.5% down. If you're putting more down, it could leave at the 7 or 11 year mark. And this gets a little lower rates usually with an FHA than a conventional, but the PMI usually makes up for it and makes it about even, so you're paying about the same percent and over time for an FHA loan. It also only requires a 580 credit score, so once again, another great way to help first-time homeowners or people that are a little bit in rougher straits qualify for a house. And now for the two loan types that only require 0% down if you qualify for it. The VA loan, whoever is going to be on that loan can only have been a U.S. military member or their spouse. So the parents or girlfriend, boyfriend, or just friends that are buying a house together, if they're not a vet, they cannot be on the loan. Their income can't be used to qualify for it. You have to meet residual income requirements, which means you can't be putting too much of your income towards the house. You have to have others for remaining income for your other expenses, and it has to be your primary residence. You can't use it for an investment property, to purchase an investment property. The USDA loan is the Department of Agriculture loan, so it can only be used in rural areas. There's a population cap. You can look it up online and see if where you're looking would qualify for that, but it has to be below a certain population to be used in that area. And you can also have this loan used to buy with 0% down payment. There is a family income limit for the Central Virginia counties around Lynchburg. It's $103,000 per family. So if you have two income earners or multiple income earners in the home, then their total income cannot exceed that, or else you wouldn't qualify for this home. And this has to be your primary residence, and it can be your only property owned. You can't buy have a house in the city and then buy one in the county with this loan. You'd have to be selling that before you closed on this next house. So we've talked about credit score and how to improve that, debt to income, why that matters, and how to improve it as well, and then saving up, what you are saving up for, and the different loan types. But some last things that you should know or even look into more as you're doing your house hunting or preparing to house hunt in the near future is talk with people that have been there before. Talk with people that you do it for a living, and that you can trust. Um, People that have been there before, honestly, if your uncle or your grandparents bought a house 20, even 5 years ago was a very different market. But if they bought, 12, 20, 30 years ago, then they may not understand everything that's going on right now or how everything works. So it's good to have voices that are doing it for a living and that you can trust out there. There's a lot of good people out there that are looking to help. And if you have any questions on qualifying for mortgages or real estate in general, I would be happy to help. And there's a lot of resources like podcasts too, with people talking about buying and investing and how to set your finances up correctly. So the more knowledge that you can get is usually the more money that you'll save when it comes time for this big investment. House hacking, if you're not familiar with that term, it means buying a home and then renting out the different portions of it. So if you're single, usually single, if you, as in not married, you can buy a house and then rent out the other bedrooms with your roommates paying for the mortgage and maybe even more, or at least making that mortgage more affordable for you. My wife and I did this after we got married. We bought a property with a house, and then there was a second guest house on it. So we rented that out, and it paid for a lot of our mortgage as well. And now both of them are being rented out. So buying a multifamily, that 2 to 4 unit can help. It's just house hacking with multiple units. And then there's some tax strategies that are available. Buying yearly, if you buy a primary residence, then you're supposed to live in it for a year or have the intentions to live in it for a year. And the primary residence always provides a lower down payment option. So it would let you acquire more houses for less money investment, and then you could turn those into rentals if you wanted to chase that path. If you are looking at getting into real estate investing, listen to the Bigger Pockets podcast. That's what got me started on a lot of the real estate stuff, and there's a wealth of knowledge over there at Bigger Pockets. And there's also tax advantages to buy a home if you live in it for 2 years. 2 out of the last 5 years, if it's been your primary residence, then you can sell it with all the equity and appreciation that's occurred there without having to pay for any capital gains over that. So that gives you some money to keep snowballing forwards if you wanted to pursue that path. And then you'll hear it said, buy the worst home in the best neighborhood you can afford, because then you go in there, you fix it up a little bit, or you just let appreciation happen, and then that home's going to appreciate faster than most other homes in your area. So here is my contact information. You can reach out to me with any questions that you have. I can help you get a loan and a mortgage to purchase or refinance in PA down to Florida, those East Coast states, but I'd love to answer your questions or help out where I can, wherever you live. Thanks. Let me know what other questions you guys have.